Welcome back, ladies and gentlemen. Well, our next session here at the Big Five Online Reconnect Days is a global economic outlook and its impact on construction, where our next guest will give his economic forecast for 2022, some of the best performing markets and future opportunities. Please join me in welcoming Scott Livermore, Chief Economist at Oxford Economics, Middle East.
Thank you for your kind words and introduction, Laura. Good morning, good afternoon, depending on where you're calling in from. It's a pleasure to be here to talk on the global economic outlook and how it impacts on construction. In the session today, what we'll look at is today, so what's been happening to make the outlook a little bit more gloomy. Then we'll consider what the post-pandemic world will look like. Are there key changes? Are there policies to unwind? And then finally, we'll wrap up by understanding the impact upon the construction industry. If we look at 2021 as a whole, the economy has been relatively robust during the course of the year. We had a weak start to the year as the beta variant took hold in different countries around the world. And then we've grown steadily through 2021. Although we've hit some recent bumps in the road, as you can see from these charts, with industrial production being flat in recent months, or on the right-hand side, the purchasing managers' indices, where 50 separates expansion from contraction. And it's clear to see that some of the pace of growth has petered out as we progressed through 2021. The GCC and the Middle East has fared a little bit better more generally. That we haven't had such a pickup or an impact from the Delta variant that's allowed economic restrictions to gradually ease and domestic activity return to normal. And of course, the rebound in oil prices has allowed the public sector, government policy, whether via entities like the Public Investment Fund or Mubadala, to enable them to support growth in the GCC and generate a relatively strong rebound. At the moment, the global economy is facing four key shocks, which have just taken the edge off the growth. We've mentioned the Delta variant already. This has led to some lockdowns, some more cautious behaviour, and slowing down the transition to normalcy. We've had issues with supply chain disruptions, where we've seen shortages in key sectors, issues around logistics, which in some cases are leaving shelves looking rather bare. Inflation has picked up. That's important because it squeezes incomes of households, but equally it generates uncertainty, which is discouraging for investment and expansion plans. And finally, there's been some recent problems in China, especially around Evergrande and production cuts. We don't think this is a layman's moment for China, but it will weaken growth and has led to downgrades in the outlook for the Chinese economy for the coming quarter and 2022. So if we look at some of those issues in a little bit more detail, firstly, the inflation and supply chain issues are interlinked. And a lot of the pickup inflation we've seen, although it's not just focused on commodities and the rise in oil prices, it is very much concentrated in those sectors that are either most affected by the supply chain disruptions we're seeing. The cars is a very big example, in how semiconductors feed into new car production, and that's led to a big rise in second-hand vehicles as demand rises. Or those sectors that are recovering from being hardest hit during the COVID crisis, whether that's accommodation, whether that's entertainment, whether that's recreation. The data here really shows what's happening in some advanced countries, Germany, UK, US, but similar trends can be seen in the Middle East. If you look at the UAE, for example, inflation was positive for the first time since end 2018 in August. This has largely been driven by a rebound in transportation services, a rebound in recreation services, and there's been a pickup in food prices during the course of the year. Similarly, inflation in Egypt has risen to nearly 6% on the back of higher food prices. rises in electricity, fuel and tobacco prices, all creating that push and momentum around over inflation in the short term. And while inflation has probably been stickier, more persistent than we would have thought 3 or 4 months ago, we still have the view that the inflation impacts are very much transitory. They may last longer than we expected, and some of the logistics and supply blockages may not ease until the second half of next year. But we do continue to expect inflation to fall sharply in the second half of next year. Inflation may be a little bit more stable in the Middle East, unlikely to rise as much in this year, given how energy prices are treated and managed. But we do expect steady increase and pickup in prices next year. You'll see a pretty much common pattern in that the impact from food prices may fade, but a gradual rise in domestic price pressures, notably in rents as the real estate sector picks up in a number of key countries. As I mentioned at the outset, the coronavirus and COVID-19 is the big issue affecting the short-term outlook. The chart on the left-hand side really does show the waves in COVID that we've seen over the last 9 to 10 months. And we're coming off the back of a sharp pickup following a rise in the Delta variant. I think what's clear and has become transparent is we're learning to manage COVID a little bit better. Each outbreak has a smaller and less pronounced impact on the economic outlook. This partly reflects policies becoming a bit targeted and management issues better, but also a rise in COVID immunity. If you look at the right-hand side, we define COVID immunity based on the number of vaccines issued, shows share of population that have been vaccinated, and also you can be immunity based on having COVID. So it's also related to previous cases. And you can see that certainly countries in this region, but also a lot of developed countries, have had an increase in COVID immunity, which offers some protection and some ease with managing future outbreaks. What this chart shows is how the economic outlook, or our forecast of the economic outlook for 2021, has evolved during the course of this year. There's been a lot of discussion of late by ourselves, by institutions such as the IMF, about how the outlook is weakened. And that is right. Since the middle of the year, we've been downgrading the forecasts. But also, if you compare our forecast today from the beginning of the year, or even in the middle of the crisis last year, we are much more optimistic, and the economy is recovering much more robustly than we were expecting a year ago, which is positive. And the final point to make about these forecast downgrades is this isn't GDP lost, it's GDP deferred. So if we look at our growth projections for 2022, then you see a broadly commensurate pickup in those forecasts to reflect activity being pushed back into next year. This chart really just shows the degree of optimism. So what it shows is quarter-on-quarter growth through 2022. So that's really highlighted the momentum of activity during next year, and it's not really distorted by any bounce back from the disruptions we've seen in 2021. If you look at the GDP bar, you can see that growth is quite a bit higher than in the previous decade, and this is expected to be sustained and really is a positive in terms of the recovery. And what's driving that recovery, and really quite different to what we saw over the past decade, is household spending. The rate of growth next year in household spending is expected to be almost double that what we've seen in the previous decade. Investment's going to continue to be robust, which is it's important for the construction sector, but the rate of growth is going to be broadly similar to that what we've been used to prior to the crisis. What this chart really shows and highlights is why we expect households to make a good contribution to the economy going forward. The left-hand side really shows personal disposable income. And what it highlights is during the course of the crisis, despite the devastating GDP impacts, household incomes were remarkably strong. That's partly due to policies like the CARES Act in the US, which sent checks to individuals, policies like furlough schemes and Kurzarbeit in Europe, which enabled employers to keep people in their jobs. And that really helped maintain income. But at the same time, individuals were unable to spend. It was not possible to travel. It was not possible to go to restaurants, go to the cinema, to socialise. It was even difficult to shop in a regular sense for goods and more generally. And ongoing COVID restrictions, uncertainty amongst the individuals meant to date we've seen very little catch-up in spending. And the net impact of that is households have accumulated significant savings. And you can see what we estimate to be excess savings over the last 18 months on the right-hand side. And this amounts to around 10% of GDP in the UK, and even in the countries with a less significant build-up is 2-3% of GDP, which is a significant amount of money that could be fed into the economy. We don't have such data for the Mideast. It's much more likely the case that the accumulations and savings have been less. We haven't seen the social security support that we've seen in some developed countries, but nevertheless, spending has been disrupted, and we would expect there'd be a degree of accumulated savings to be released. So together, what does that mean for the post-pandemic world? In some parts of the world, the post-COVID world, will look at a surface level fairly similar to the pre-COVID country world. Most countries' GDP would have returned to pre-crisis levels by the end of 2022. And economic scarring, so how much GDP is now going to be lower than we expected pre-crisis, so that lost output, is non-existent or very limited in most economies. The exceptions are emerging markets where there has been less social support, less effective vaccine rollout, and then the economic cost is likely to be more persistent. In the Mideast, the scarring really depends on how quickly the oil markets normalise and how active the governments are in supporting the recovery. And there's reason to be more optimistic about, say, the UAE and Saudi Arabia, and to be slightly more pessimistic about the outlook in Kuwait and Oman. Although the impact of the headline GDP looks relatively unaffected, there's going to be some noticeable changes underneath that: supply chain shifts, adoption of technology, working from home patterns, all of which are likely to be permanent. In addition, there's some policies that need to be unwound. We see it here from fiscal measures. There's a huge amount of fiscal monetary support in the economy. As we look forward, this will become much more targeted, much less generous. To a degree, the oil producers in the Middle East can buck this trend. Similarly, monetary policies unwind with quantitative easing being scaled back and interest rates rising. We expect the Fed in the US to increase interest rates by the end of next year, which will feed through into tighter monetary policy in the Gulf. There are really some difficult policy decisions here, balancing in tackling inflation, balancing in managing the fiscal position, while not knocking the recovery off track. And getting this wrong could have a serious impact on the outlook. This chart shows net savings for different components of the economy. We can see the blue line from the households, the excess saving, the borrowing from governments in the yellow, both of which are supposed to unwind over the forecast period. What is quite striking is the red line associated with corporates. Typically, they're net borrowers because they borrow to invest, but you can see borrowing's been picked up during the crisis, unsurprisingly, but that only slowly unwinds during the forecast, suggesting that businesses want to continue to sit on reserves of cash. And the consequence of this is reflected in business investment. While we expect a strong recovery in business investment, and what we tried to do here is the recovery in business investment now, the blue lines, overlaid on that during the global financial crisis. And you can see the recovery now is much stronger. Given the reluctance of businesses to spend, that rebound is going to be a long way short of pre-crisis trends. And by 2023, 2024, business investment is likely to be below what we were previously forecasting pre-pandemic. And this has repercussions for construction sector, especially with those undertaken by businesses. So on that note, what does this macro outlook mean for the construction sector? At a very aggregated level, we expect construction in residential to rebound really quite quickly, growth of about 7% this year, with a similar strength next year. And with residential sector accounting for about 45% of total construction, this will be a key driver over the overall market. In the residential market, we're seeing a sharp increase in house prices in a number of countries as this pent-up demand we've been talking about in the wake of the pandemic is released. These excess savings by consumers will drive housing market in the short term and particularly stimulate residential renovation, upsizing of residential spaces, even the conversion of redundant spaces into residential. We expect the Americas to be the fastest growing sector in 2021, although APAC will continue to be the largest market. And significant expansion in the Middle East is likely to be seen, especially in those countries with more rapid population growth. The non-residential sector will be the slowest to recover as the pandemic and the lockdown have had more serious impacts in many sectors such as retail construction, entertainment, office spaces, and that's likely to persist. And similarly, as we've just been discussing, the lackluster or relatively lackluster pickup in business investment will weigh on this sector. Over the forecast, we expect infrastructure to be the most rapidly growing sector out to 2030 at a global level. We expect average growth in excess of 5%. This is in part driven by unprecedented levels of government stimulus. You can see that in the US with the $1.2 trillion bipartisan infrastructure bill that lead to major spending on highways, railroads, repairing old bridges, or in new tunnels, really pushing infrastructure space. Similarly, there are significant infrastructure mega projects, such as NEOM in the Kingdom, which is important for driving it. And one factor that's talked about a lot, which will help drive the renaissance in infrastructure spending, is global environmental aims. To give an example, the emergence of electric vehicles globally will require increased investment, both in electricity generation as well wider electrification across the economy, and also the development and deployment of rapid charging infrastructure. The ability of governments to support this spending, especially given the relative lackluster private sector, really depends on the finances of the government. The chart on the right-hand side shows that public debt in the Middle East tends to be lower than other major countries in the world, which gives the region access to finance. And it probably understates the advantages the region has with the sovereign wealth funds, such as MUBDA, the public investment fund that I mentioned earlier. They have great financial wealth, which they can deploy should they want to focus on investment. And the signs are that they will. In October, we've seen both the UAE and Saudi Arabia announce net zero targets. Along with that, has been investments in excess of $150 billion in both countries. Now, some of the details need to be worked out, and it's not entirely clear. But that amounts to nearly a quarter of Saudi GDP and 40% of UAE GDP. So they have the wealth and the means to do that. Elsewhere, there may be greater reliance on PPP. So if we look at the outlook in aggregate, we expect global construction to respond strongly. 7% growth this year, 5.5% next year. Growth be relatively evenly split between emerging markets and advanced economies. In the US, construction will be driven by the Biden stimulus plan, pickup in the residential sector. In China, civil engineering has driven construction this year amid government support. But as the government stance becomes a bit more neutral, we expect the pace of construction to slow and shift away from infrastructure projects towards non-residential and residential construction. The picture in the Eurozone is mixed, with confidence dipping in France and Germany, but picking up in Italy of late. And across the Middle East, we expect there to be robust and relatively strong construction outlooks, particularly in those countries that are implementing ambitious and rapid diversification and growth plans. This means the strongest growth is likely to be in the UAE, Saudi Arabia, and Qatar, as the significant projects such as NEOM, the World Cup, that go with the diversification plans are implemented. This chart really shows a heat map. I'm not going to go through all the details here, and it's really something to review when the slides are distributed. But really what I wanted to highlight here is the detailed forecasts that are available. The analysis in this presentation has been drawn from Oxford Economics Global Construction Service, which covers some 34 countries, and it blends together the mix of top-down macroeconomic and demographic drivers that we've been discussing in this session, but also brings in bottom-up information on major projects, construction programs, and other in-depth knowledge on the construction sector. But what you can really see here is how construction is supposed to be picking up over the forecast. The countries such as Taiwan and Saudi have been robust during the crisis, but there's a broad-based significant pickup over the outlook. And to sum up and to wrap up before we move on to Q&A, the Delta variant, supply chain issues, inflation have really led to a softening of the growth outlook. This is not growth lost, it's really delayed, and we remain relatively confident that economies will power back to close to pre-crisis trends. In the short term, the consumer is going to be key to the recovery. This will benefit residential investment, but business investment is likely to be slower recovery, given it's been so hard hit and some of these problems are going to be ongoing. And this will be a slight drag on non-residential construction. Fiscal policy is broadly set to be contractionary going forward as we rein in some of the support. But within that, policy and structural shifts are going to be very much focused on preparing the economy for the post-COVID era, preparing to deal with climate change. And we could see some significant investments around the world, particularly in those countries with easier access to finance and allowing the public sectors to support the recovery. With that, I'll pause and happy to answer any questions you may have regarding the presentation or anything to do with the economic outlook.
Well, another excellent session there. Thank you so much once again to Scott Livermore, and thank you for also staying with us to answer some audience questions. Now, a very sort of positive outlook here. You mentioned that, most economies will be going back to sort of pre-crisis levels, by the end of 2022, which is a fantastic outlook, and also for the Middle East, very robust sort of going forward. Now we've got quite a few questions that have come in. So the first one here. Now you mentioned PPPs in your presentation. What is the importance of PPPs for this region in particular for future growth?
Thanks for the question, Laura. I think PPP is potentially quite dynamic and important for the region. Although oil prices are back from their lows and in the region of $70 to $80 and won't deviate too far from there, that doesn't give governments a lot of access cash. So we have a situation where spending will remain relatively tight, but it become apparent that there's some infrastructure gaps that need to be addressed. And PPP could be an important mechanism to close that gap. Already, Dubai, Kuwait have a significant track record, been implementing over the last 10 years or so. But as a whole, PPP's struggled to get going over the last decade. It's been largely stop-start. And if you look at the rest of the world, there's been success in Canada, Australia, but it's pretty much ground to the halt in the UK. So it could be a potential lever. The governments in the region probably have to improve laws and legislation, increase experience with procurement for PPP opportunities, and then have a significant basis to build on. It's worth noting that in Dubai recently, $25 billion in PPP investments been announced. I think PPP is probably a cornerstone of Vision 2030 in the kingdom, and they contribute to some of the investments there. And in some of the kind of countries with tighter finances, such as Bahrain, potentially Oman, it could be an important support for upgrading the economy.
And moving over now to sort of global environment issues that you mentioned as well, and obviously with these net zero targets for the Kingdom of Saudi Arabia, obviously that's going to boost investment as well. So another question has come in with regards to some of the different markets that are most associated with climate change, and will have a positive impact on infrastructure investment. Which markets are those in particular?
I think the first thing to say is the Middle East as a whole is extremely vulnerable to climate change in terms of economic cost. It is very exposed, so it's in its interest to support a global agenda. I think the countries where you're likely to see the biggest investment are those that, one, who can afford it, and two, that have already announced those net zero targets. So we mentioned the UAE, we mentioned Saudi. I forgot to mention Bahrain, but they've announced net zero targets. And in these countries, you're going to see significant investment, firstly on green technology, so renewables in power generation, and technology to upscale housing and buildings to make them much more environmentally friendly. But there'll also be significant investment in new technologies. So I think hydrogen is potentially the golden goose, but it's a long way from being marketable. But that is an area ADNOC or Saudi Aramco can take a lead in and then build expertise and infrastructure around there. The other countries in the region are likely to follow. If you look at North Africa, part of the Middle East, or the non-oil rich countries, they have less wealth to invest, but nevertheless, the need's going to be there, and they may be laggards over the next decade, but investment will surely happen in the rest of the regions.
And well, speaking of investment, going back to investment, another question has come in. Which sectors will be the best to invest in the Gulf region, and in which countries in particular as well?
Oh, that's a big question, but let me have a go at answering that. I think in terms of the countries, that's probably an easier question. I'm relatively confident about the leading Gulf countries, be it UAE or Qatar, who've kind of done a lot of good work over the past decade. But increasingly, Saudi Arabia is implementing the right policies, the right frameworks, supporting it with lots of domestic money, which should encourage private sector, both domestic and foreign, to follow through. And its kind of application to host Expo 2030 really gives it a very public arena to validate its Vision 2030. And that really does ensure a commitment to stick the course, which should give confidence to investors. I think in terms of sectors to invest in, that they're going to be broad-based. Clearly, there's travel and tourism is critical to the region as a whole and supporting those kind of sectors. I think a lot of digital investment work undergo in the region, and those that are kind of classified as Industry 4.0 would be good sectors. And then I would not neglect energy. I know it's easy to think the region is dependent on old technology, oil and gas polluting, but I think it is trying to look at itself as a leader in new energy in the broadest sense, and that could offer some attractive investment opportunities.
Now, at the beginning of your presentation as well, you mentioned inflation and supply chain issues and how they're very much sort of interlinked. And they're sort of concentrated in most industries as well. So this question is very interesting. How do you think the impact of disrupted supply chain has been reflected in these economic outlooks? Has that been the main sort of factor, do you think?
Well, at the moment, the main factor is COVID, and it has been for the last 18 months. We're moving into the post-COVID era, and I think supply chains are really playing at the moment. So if you look at Europe, Germany in particular, some of the recovery has been slowed down because of bottlenecks in its supply chain network. If you look at the US, it's playing out much more on the inflation sense, which could have an impact on interest rates over next year. Will the Fed hold on to the end of next year or increase interest rates earlier? So it is playing to the fore. At the moment, and the longer it goes on, maybe it's a bit harder to stick to this conviction, we view the supply chain disruptions as transitory, and we think they will unfold. Some will take longer than the others. Some of the logistics you may be able to fix quicker, whereas ramping up supply in semiconductors may take longer. But during the course of 2022, we do expect those bottlenecks to ease, and some of the disruption that we've seen over the last couple of months and likely to see over the next couple of quarters to unfold. And as I said in the presentation, it's kind of recovery delayed rather than recovery lost because of these factors.
Another sustainability question here. Do you think there will be a major shift towards sustainable spend? And do you think policies in the Middle East will change in the near future?
I think there will be a shift to sustainable spending, both public and private. I think what's really interesting is if you look at the global financial crisis, in many ways that killed the green agenda. There were times when sustainability was rising prior to the financial crisis, but post, all people really worried about was growth and jobs. I think it's clear in this recovery, it's kind of enhanced the green agenda, and the focus on growing back better, or whatever the catchwords are really key. I think the Middle East has the potential here to accelerate its development and climb the league tables, if you like. As I said in the presentation, we have, in many ways, visionary leaders. We have politicians who can implement what they want relatively unconstrained, and there's significant financial resources and financial means to drive the green new economy as the countries in the region pursue their diversification and growth agendas.
Just a couple more questions now before we wrap up. How will industrial slowdown in China affect the construction sector here in the GCC? That was another one that came in.
Oh, the direct linkages are relatively limited. Clearly, the big impact from China is imports to the region, which is maybe affected by price. The direct linkages from the exports market from the region to the Chinese is still relatively small in the non-oil sector. So while the slowdown in industry and some of the construction difficulties will have an impact in China, have an impact in the rest of the world, at this stage, we don't think the spillover impacts are going to be that significant. Already, the authorities were dialing back on the Belt and Road Initiative, which is probably the most important aspect of Chinese investment in the rest of the world. And I doubt that will be exacerbated significantly by the current difficulties in China.
And this is the final question that's come through for you. Now, you mentioned that the outlook is better than envisaged at the start of 2021. What exactly has affected this change?
Well, I've mentioned it's all about COVID at the moment, and I think we've learned a lot about COVID. As we've gone through 2021, the waves of the virus have become less disruptive. The economic support governments have put in place have been effective, but with vaccines and better management, there's been less disruption to the economy, which we didn't fully appreciate when we were making our forecast 10, 12 months ago. And just to put that in this context, everyone's worried about the Delta wave in Europe and whether there may be some lockdown conditions. I think economists accept that could dent growth, but we don't expect it to derail growth or cause a recession like we saw at the end of 2020.
Well, as I mentioned, a very robust outlook going forward, especially here for the Middle East region. Scott Livermore, thank you so much for joining us. It really has been fantastic speaking with you. And thank you for that global economic outlook. Thank you.
Thank you.
Well, ladies and gentlemen, we are now going to take an hour's break and we'll be back here at 1:45 Gulf Standard Time with a panel discussion on net zero opportunities and challenges. So we'll see you then at 1:45. Thank you so much.